There's a question that almost every first-time buyer in New York City gets wrong, and it costs some of them months of wasted time, rejected mortgage applications, and in some cases, a deal that falls apart at the worst possible minute. The question is, co-op or condo? Most buyers treat this as a lifestyle choice, like do I want a doorman building or a newer kitchen? But what it actually is a financial decision that affects your mortgage, your down payment, your monthly costs, the flexibility you have with the space, and the ability to sell at the time when you want to. And nobody explains this from a mortgage perspective until now. I'm Nicole Hamilton. I'm a mortgage broker in New York, and I specialize in first-time home buyers. By the end of this video, you'll know exactly how co-ops and condos differ, not just in lifestyle, but what it means for your financing, your flexibility, and your long-term wealth. Let's start with the number that surprises everyone. In Manhattan right now, the median condo price is about $1.7 million. The median co-op price is about $850,000. That's not a small gap. That's nearly double, which means if you're a first-time home buyer with a $100,000 down payment, the co-op market opens up an entirely different set of options than the condo market does. And here's the thing most buyers don't realize. In New York City, 70% of the apartments for sale are co-ops, not condos. So if you've been browsing listings and assuming that you're going to buy a condo, you may be looking at 30% of the market and wondering why nothing is in your budget. Understanding this distinction is not optional in New York City, it's table stakes. Let me explain what you're actually buying in each case. When you buy a condo, you're buying real property. You get the deed, you own the unit. It's the same way you'd own a house anywhere in the country. When you buy a co-op, you're not actually buying real estate. You are buying shares in a corporation that owns the building. Along with those shares, you get a proprietary lease, which gives you the right to occupy your apartment. This distinction sounds technical, but it has real consequences for your mortgage, your taxes, and what you can do with the apartment. Here's where it gets directly relevant to my world of financing. For a condo, you get a standard mortgage. Your lender takes out a lien on the property. It's very straightforward. For a co-op, you get what's called a share loan or a co-op loan. Your lender takes a security interest in your shares of the corporation, not in the real estate. Why does that matter? There's two reasons. First, not all lenders do co-ops. Many national banks and online lenders do not lend on co-ops at all. So if you're a co-op buyer and you went to a big bank and got turned down, it may not be your financial profile. It may be that they simply don't do this kind of loan. This is one of the reasons why working with a mortgage broker matters in New York, because I have access to lenders who actually specialize in co-ops. A direct lender doesn't do co-ops, and they may never tell you that. They'll just decline you. The second reason the loan type matters is co-op buildings themselves have to be approved by the lender. The building has to meet certain financial standards. So do condos, but they're a little different for co-ops. Reserve funds, owner occupancy ratios, and pending litigation. If the building doesn't qualify, the loan doesn't happen, regardless of how strong your finances are. I review the building financials before my clients fall in love with an apartment, because finding out that the building doesn't qualify after you're in contract is a very bad day. Here's the part that scares most first-time buyers, the co-op board approval. When you buy a co-op, the building's board of directors, which is made up of other shareholders, your future neighbors, has to approve you as a buyer. They review your finances, they interview you in person, and they can say no. Here's the reality. For most financially qualified buyers, board approval is a process, not a barrier. The interview takes about 30 to 45 minutes. They want to know that you can pay your maintenance, that you'll be a good neighbor, and you're not planning to immediately sublet or flip the apartment. What kills board applications? Financial ratios that don't meet the building's specific requirements. A board package, the application that is disorganized or incomplete, or signs that you're financially overextended. The board package is something that I help my clients prepare for because the way you present your finances on paper matters just as much as what the numbers actually are. Condos, by contrast, can have a right of first refusal. The board can match any offer and buy the apartments. But in practice, this almost never happens. Condos do not interview you, you buy and then close. Let's talk about monthly costs, because this is where a lot of buyers are surprised. In a co-op, you pay monthly maintenance. This covers the building's operating expenses, staff, and here's the key part, the building's underlying mortgage and property tax. The last part is important. Your property taxes are wrapped inside your maintenance payment. You don't pay them separately. In a condo, you pay common charges, which cover the building's operations, and then you also separately pay your property taxes directly to the city. Right now, co-op monthly costs run about $2.50 per square foot, maintenance included. Condo common charges plus taxes run about $3.30 per square foot. On a 700 square foot apartment, that's a difference between roughly $1,800 a month and $2,300 a month just in carrying costs before your mortgage payments. One advantage of the co-op as a structure is a portion of your maintenance that goes towards the building's mortgage interest, and property taxes may be tax deductible. Ask your accountant, but it's a real benefit that condo owners don't have in the same way. There are two more differences that matter for your long-term plan: flexibility and resale. Co-ops have rules. Most co-ops require your apartment to be your primary residence. Many have strict subletting policies. Some allow it after a year or two, and some barely at all. And any renovations need board approval. Condos are significantly more flexible. You can sublet your apartment, you can renovate with fewer restrictions, and you can sell without anyone interviewing your buyer. For a first-time buyer who plans to stay, co-op restrictions usually are not a problem. For someone who may want to move unexpectedly or wants to rent it out, the flexibility of a condo has real financial value. On appreciation, both co-ops and condos have appreciated strongly in New York City over time, but condos have historically shown stronger appreciation in market value because of their flexibility and because international investors and buyers prefer condos. Co-ops, because of board restrictions, have a more stable but sometimes slower moving market. So which one is right for you? Here's how I think about it with my clients. If you want more space for your budget, you plan to stay long-term, and your finances are strong, a co-op is often the smarter purchase in New York City. More inventory, lower prices, and lower monthly costs. However, if you want maximum flexibility, you might want to sublet and are buying partly as an investment. The condo premium may be worth it. If you're buying with a partner, a sibling, a friend, co-ops can be more complex because some buildings are restrictive about multiple unrelated buyers. It's solvable, but it needs to be figured out upfront. The most important thing to think about is what you're choosing before you fall in love with a specific apartment, because switching from condo to co-op mid-strategy can really cost you precious time. So in summary, co-op and condo is not just an aesthetic choice in New York City. It determines which lenders you can use, how your mortgage is structured, what your monthly costs look like, and how much flexibility you'll have after you close. Getting this clarity before you start searching can save you months. If you want to talk through which makes sense for you in your specific situation, your budget, your timeline, your preference, The link to schedule a meeting with me is in the notes. 30 minutes, no pressure, real answers. I'm Nicole Hamilton. I make content like this every week for first-time homebuyers navigating New York City. Subscribe so you don't miss it. And if this was useful to you, send it to someone you know who's starting their apartment search. They need to see this before they fall in love with the wrong building. I'll see you in the next one.